Hey everyone, it's Rob B here with Rob D, and today we are going to answer the question, what would happen if you bought property at the absolute worst time? People are always nervous about are they buying at the right time? But let's go back in history and look at what would happen if you actually did buy at the worst time. The numbers are crazy.
Yes, welcome to the Property Podcast. Thank you for joining us. And even though property is what we do for a living, we do it all day, every day, we still come across some numbers and data that really surprise us and get us thinking about property in a whole new way when we're researching these episodes. So if you've ever had any doubts about whether it's a good time to be investing in property, you're nervous about investing at the wrong time, you will definitely want to stick around.
So it's time for our news story of the week, and the headline reads, Epic fail. Rents go up in Scotland despite government rent controls. Now, you may be thinking, what I originally thought was, how can rents go up when you have rental controls? And we've reported quite a bit on this podcast how rent controls haven't really been working in Scotland, and they probably then therefore won't be introduced into England and Wales because of how poorly it's gone. But Rob, this is just further evidence that rent caps don't work, but I think it's important to begin with to explain how can rents go up when you have a rental cap?
Yeah, the answer to that is that rents are capped within a tenancy. So once someone's moved in, for when this was first introduced, you couldn't raise rents at all. I believe now you can raise them by 3% a year. I can't quite remember the details, but it's something like that. But that's within a tenancy. When you're advertising a property to let to new tenants, you can set the rent to anything you like. So it doesn't matter what you were charging the previous tenant. You can set the new rent to absolutely anything. And of course, you're more likely to set the rent as high as you can get because you know that once someone's moved in, you're then limited with how much you can increase it. So put that on top of the fact that, of course, rent controls are going to decrease the amount of supply coming to the market, and you end up with a double-digit rental growth, which is being reported here. And rents in Scotland are rising faster than anywhere else in the UK except London. So not a great advert for the policy.
No, it's not, Rob. Far from it. You know what would be a great policy? A policy that mandated everybody to read our article in the Sunday Times each week. So if you're picking up your property news at the weekend, pick it up in the Sunday Times, where Rob and I, like we do every week, will be answering property questions in the home section. So make sure you pick a copy up this weekend and check out what we're doing there. It's just a bit of extra property content that you can pick up from us each and every week. So that's the Sunday Times home section out this Sunday.
Now, just before we get into our main topic this week, a quick mention that we had our first ever Property Hub Select meetup last week. And Rob, wasn't it great to get out there and meet people who are not just listening to the podcast, which of course makes them excellent people, but also are so committed to using property to better their lives and push forward? I just found it so inspirational.
Yeah, I absolutely loved it. It's just such a lovely group of people. It's been so long since we've done a meetup, and we don't get to meet that many of our community in person that often. So to suddenly have a lot of people all at once in one space that you could talk to was brilliant. It was so nice. Our community is so lovely. Just thank you. Everyone was just like really supportive. It was the first meetup we'd done in years, so we wanted it to be as good as it could be, and everyone was like really supportive and making that happen. And I just woke up the next day like really like still buzzing. Like I'm so happy with how that first one went. I mean, if that was the first one and we're going to try and improve from there, then I'm really excited about what the future holds. So for those who are thinking, wait a minute, how do I get along to one of these meetups? It's a Property Hub Select meetup, and it's a cool community that we are creating for anybody who is a client of either Property Hub Invest or Portfolio. If you'd like to find out more, go to propertyhub.net/select.
When you're investing in the stock market, everyone tells you to average in. So rather than throwing all your money in at the same time, spread it out. Do it a little bit month by month, because that way you're minimizing the risk of the market dropping the next day and you've, on paper at least, lost money. With property, unless you are super ultra mega rich, you can't really be doing that. And that gives rise to a real fear among investors, which is buying at a bad time. It comes up with pretty much every new investor we speak to. They want to buy, they understand the power of buying, they're in a position to buy, but they're held back by this fear that right now might be a bad time. Well, in this episode, we're going to look at what happens if that fear becomes reality. What would have happened if you had, in fact, bought property at the worst possible time?
And I think it's important to emphasise that, Rob. It's not a bad time, not what's perceived to be a not so good time to buy property, but the worst times you could have bought property. So we've taken data from over the last 40 years and picked out the 2 worst points in the markets. The 2 crashes you probably will be familiar with. The crash in the noughties and the crash in the 80s. We'll give you the specifics and the timings in a moment. But the absolute worst times. So there's no cherry picking here. We're just going to the dirty, dark place of those periods and times and looking at what would have happened if you had unfortunately put your hand in your pocket at those moments and bought yourself a property.
Okay, let's start with the one that most of us can probably remember, the crash of 2008. But the peak for every region in the country, everywhere peaked at the same time in the third quarter of 2007, where the UK average property price was £184,000. So if you'd bought in, say, September 2007, you would not have just been buying in the worst year, you would have been buying in the worst possible quarter. So if you had done that, how long would you have your head in your hands for? How long would it have taken for prices to get back to the price you paid for it? And we're talking in purely nominal prices here, so we're not taking inflation into account. So on average, the bad news is it would have taken 7 years for the price to get back to what you paid for it. So on paper, you'd have been in a losing position for 7 years. But that's the UK average, Rob. And of course, no one actually buys the UK average property. They buy a property in a specific region. And there are some big variations depending on where in the country you bought.
Indeed, and we've talked about this a lot, but you probably can remember that London was the area, the region, that bounced back the quickest. Within 5 years, the London property market had regained all its losses and was at a break-even point, and then kicked on quite a bit from there. So London, the top performer. It may come as then no surprise that just behind London is the southeast and that ripple effect taking place there. And it took 6 years for property prices in the southeast to recover. So a reasonable amount of time. It probably felt like a long time for those people who bought at the absolute worst possible time. Remember, this is not people who bought 6 months before the worst possible time. This is buying the worst time. It took 6 years in the southeast. The northwest, though, Rob, quite a bit longer. 11 years for property prices to bounce back. And it seems the further north we go, the worse it gets, because Scotland was 13 years. 13 years for property prices to recover. I actually can't believe the next one, Rob. And I'm sure this has been well researched and we've fact-checked everything that we've got here today and all the rest I believe. But it says here that Northern Ireland still hasn't recovered and is still 19% below its peak. I trust the research, but wow, I kind of also struggle to believe it.
Don't trust the research because it's only me. We haven't got a team of fact checkers, so I'll ask producer Dan to go onto the land registry and fact check this in the background. But unbelievable though it is, I am pretty convinced that this is true. Not being back to its peak after 16 years is one thing, but still being 20% below that peak is pretty extraordinary. But even if you leave Northern Ireland aside, the gap between Scotland at 13 years and London at 5 years obviously is vast. And I'm already thinking about lots of observations and lessons that we can pull out of that. But before we do, how about we go back and look at the previous crash and see if there was a similar pattern back then?
Okay, so the peak in property prices was again in the third quarter. So watch out for third quarters. In 1989, and the peak at that point for the average property in the UK was £63,000. The recession, as many will probably remember, was in 1990. But just like before, the peak in property prices was just a little before the recession. Now, Rob, this time around, the amount of time for UK property prices to recover, the average UK property, was 9 years. So a little longer than it was in 2007. Not a lot of difference, but 2 years probably feels a long time when you're living it, though. So that is the average. But Rob, as we've already heard, that's an average, and the regions can play out a very different game. So do you want to take us through the regions and how they performed and how long it took for property prices in those areas to recover?
Yeah, this is fascinating because last time London was the quickest to recover. This time it wasn't. It took 9 years, bang on the UK average, and the southeast 10 years, so pretty much average as well. So last time we saw London recover fastest, and it seemed like the further north you went, the longer it took. In 1989, absolutely not the case at all. So London 9 years, southeast 10 years. The Northwest, interestingly, didn't peak until 2 years later. That peaked in 1991. Then it took 7 years to recover, so actually faster than London and the Southeast. But then what's really interesting is that if you go and look in Scotland and Northern Ireland, and remember how poorly they did after 2007, in 1989, it only took a year, 1 year in each of those cases for values to recover. There was barely any fall at all. So a completely different pattern there. And we can come on to speculate about why that might have been the case and what we can learn from it. But first, Rob, I think you made a very important point earlier that's worth emphasising and putting some data around, which is, you rightly said, we're talking about if you bought at the worst possible time, not close to the worst time, the worst quarter. So you can expand from that and go, okay, well, if that's the worst time, how long is close to worst? How long is bad? In other words, how long is the window where if you bought, you would have then lost money in the crash? And I think the numbers around that, Rob, are really interesting.
I think it's stunning, Rob. And this is the first lesson, but probably the most important to take away from this podcast, is that you would not have lost any value as long as you avoided, in the 2007 cycle, the final 3 years, and the 89 cycle, the final year and a half. So across over 40-year time span, if you had avoided just 4.5 years in the last 40 years, you would have done incredibly well from property. That is such a small window. The chances of you getting it right in property, if you're an expert or not, are way in your favour. Less than 10% of the time is an absolutely awful time to buy property. If you'd bought 4 years before the '07 crash, when the property prices settled, they were still higher than what you bought at. And '89, if you'd bought 2 years before the crash, when property prices settled, they were still higher than what you bought at. Now, when you think about it that way, it probably, hopefully at least, starts to shift your thinking around property markets and how you feel about them. Because unless you get it really, really wrong, then you will be fine even if there is a market crash. And remember, we are picking the worst quarter. If you'd done a year before the '89 crash, so in that window that we just talked about, it wouldn't have taken that long to recover. It would only take you a few years. So it's only if you truly buy in the worst quarter of the winner's curse that you will be punished. And Rob, I think that's the key here, is we've talked about the winner's curse in the property cycle, the 18-year property cycle, many, many times. And we've always said that's the time not to buy. But actually, the winner's curse is a time not to buy, but it's the worst quarter within the winner's curse is the time you really don't want to buy. You probably will be forgiven if you're even a few quarters away from it, but being in that quarter is a true winner's curse.
That's right. We've talked about the 18-year cycle a bit recently, and the most recent time we talked about it, a couple of weeks back, we were pretty negative. We were doubtful about whether it even applies at the moment, whether it's on track, and doubtful about its predictive value, its usefulness as a model. But in that episode, I said that even if you throw out a whole load of it, I think the bit that you can keep, and that still has a tremendous amount of value, is that it guides you towards doing the opposite of everyone else at two really important turning points. It can give you the confidence to go in and buy when everything is looking terrible at the absolute depths after the crash, which is when everyone else is too shell-shocked by what has just happened to even think about property. That's the time to be getting in. And it also guides you away from buying at what we've called the winner's curse. These final couple of years, and indeed the final couple of quarters within those couple of final years, which is when everyone is going crazy on property. And that, as we've just seen, as we've just had the numbers around, is when you definitely do not want to be buying. And ideally, you want to be offloading the stuff you don't really want anymore to all those people who will keenly pay a load of money for any old rubbish, bolstered by banks who are keen to shovel money out of the door as quickly as they possibly can. We love sharing our knowledge with thousands and thousands of people on this podcast, but sometimes it's nice to have a smaller group as well, and that's what Property Hub Select is all about. With Property Hub Select, we're able to put on extremely high quality, exclusive in-person events and interactive online masterclasses that helps our ambitious members approach property investment on a whole different level. And the best thing is, Property Hub Select costs nothing at all. It's all free for our clients. So to find out if it could be right for you, just visit propertyhub.net/select.
So this begs the question, how do you know if we're approaching one of those horrific quarters in time? Not just a year, but one of those quarters. Well, what happened on the way to those quarters? Well, we had an incredible market boom both times around. Both times around, the market was red hot. And then, after a big boom, came a big bust. And buying at the top of that boom was clearly when those quarters were. So, Rob, I think pretty much everybody, without exception, listening to this podcast will agree we are not in that environment right now. We are not in a booming market. Far from it, actually. Property prices are actually slightly down the last 12 months. And in real terms, down a bit. So property prices are not booming. The market we are in right now does not resemble anywhere near what happened previously. So if you're a bit of a nervous Nelly and you're thinking, should I, shouldn't I, and the market makes me a little nervous at the moment, you have to remember that history tells us that buying at any point other than the worst quarters, you'll be fine over the, well, not even the long term, the medium term. So I think one of the big takeaways from this podcast is that you should start to feel a little better about what's happening. Yes, there's always negativity going on in the world and in the markets, and sometimes the market's going up a bit, and sometimes it's going down a bit. But the only times really you should take note and go, am I making the right decisions, is when the market is absolutely red hot and the numbers are going up and up and up. Because you know what follows soon after is those crashes.
That's right. I think we can conclude that buying at the worst time is really bad. You don't want to spend 7 to 9 years with your property being worth less than you paid for it. I mean, it's not a disaster. I mean, you're still collecting rent for that whole time. And as long as you were planning to hold it for the long term anyway, and you're not forced to sell, it's hardly going to be a road to financial ruin. But you don't want it to happen. But the good news is that buying at the worst time is actually pretty hard to do. It's a very short window. And I think this is important because it comes back to what I said right at the start. With property, because it's so lumpy and illiquid, you can't just average into it. So for most people, there's going to be periods of time when they can't buy because they don't have the funds. They're saving up. And there's going to be times when they can. And when you're in a position where you can, well, that's when you get into should I? And the should I zone is a really tricky one. Because if it's a possibility, I mean, yeah, I probably do want to invest in property, but is now the right time? Then that whole time, you've just got money sitting around in cash, so it's not doing anything for you. If you had no interest in property and you'd just been putting that cash into the stock market as you got it, or some other type of investment, all good. But the whole time you're sitting there dithering about whether you should, whether you shouldn't, maybe I should wait a bit because this is about to happen and all that's not looking so good, then all that time, you've made no investment at all. And you won't be able to make any investment until you've either convinced yourself that it is the right time to buy property or given up on the whole idea and gone and invested in something else. And that's why I think, Rob, that this is actually quite reassuring for those people. Because like I said, everyone's terrified about buying at a bad time. But I think what we've concluded is there isn't that much of a bad time. There's a very small window of really bad time. But the great thing about it is it should be really massively red light flashing obvious when that's happening. Prices don't just amble along and then fall off a cliff and everyone goes, oh, I wonder why that happened. It's always preceded by a screamingly obvious boom. And that screamingly obvious boom is the time that you don't want to be buying. And I know that psychologically that's tricky because that's the time when everyone else is buying. But having listened to this episode and understood the history, avoiding those moments should be really easy. And then the rest of the time is basically fine.
But let's give you a real example. So the most extreme numbers we've talked about in this episode on Northern Ireland. Yes, it's true. It's been fact-checked. Northern Ireland has still not recovered from its property crash. So that's kind of scary, right? Imagine sitting here today, having bought it in the worst quarter possible in the history of the Northern Ireland property market. You are still not back to where you were. Now, if you are new to property or you're thinking about making an investment, that might terrify you. So let's look at the numbers. Can we get reassurance from the numbers? What were the signals? What were the alarm bells? Were they there? Well, in 2004, property prices went up. And they went up nearly 9%. So that's a strong year. 9% growth in 1 year is pretty good. You could say that's a boom because it's above average. So if you see property prices go up by 9% in the year, is that the alarm? No, not even close. Because the alarm wasn't a 9% increase. The alarm was a screaming increase. Because from January 2005 to the middle of 2007, which is near the peak of the market, property prices in Northern Ireland more than doubled. Yes, in 2.5 years, property prices in Northern Ireland doubled. If that is not a screaming alarm, then I don't know what is. You have to remember that in the 70s, property prices did go up by a similar amount. The average was actually a bit longer than that. But that was backed by high inflation. This was a low inflationary market when this took place. So with low inflation, property prices have probably never seen such growth in any region at any point in time in history, doubling in 2.5 years. That's absolutely crazy. So at the beginning of January 2005, property prices in Northern Ireland, the average price was 111,000. By the summer of 07, July 07, they were 224,000. 111,000 to 224,000 in 2.5 years. That, ladies and gentlemen, is your screaming alarm bell. If the property market happens to double in the space of 2 years, just over 2 years, then that probably is your indication that I should not buy right now. To see the extreme downside that the Northern Ireland property market is seeing, that's the extreme that you have to go to in the boom. And for context, for those who bought at the beginning of 2005, so they'd just seen property prices go up by nearly 9% in 04, so they'd done well. If you bought at that point, then you've bought in at 111,000, as I've said. The property market bottomed out eventually in Northern Ireland at 97,000. So you just lost just over 10%, but then it didn't take long to recover. Today, the average property price in Northern Ireland is 172,000. So if you purchased at the beginning of 05, after a year of 9% growth, you would still be up today and up quite a bit. And in fact, if you'd bought in January 2006, it was 131,000. So you'd seen another year of strong growth. You'd still be up today. So even in the most volatile market in probably the history of UK property, it was only towards the very end of that most extreme market that you would have felt that pain. So those numbers are scary when you just hear them in isolation, while they're still down by 19% today. But you have to remember and understand how bonkers that market was. And it's only if you bought right at the end of that bonkers market would you feel that punishment. So when you look at all the information we presented you today, that you have to avoid the most extreme markets in the most extreme times. But if you do, and now we've heard they're pretty obvious to see, you'll be fine. And to me, that gives me a lot of comfort as a property investor. So it's time for Hub Extra, and I'm very excited that we've got a property-related Hub Extra this week. Rob will often bring in bits of tech and the apps that we've seen and all sorts of different bits and pieces, but it's not very often, now we're over 10 years in, that we bring a property resource. But I'm pleased to say today is one of those special days.
Yep, this will come in useful on average once every 19 years, which is the average amount of time that it takes people to move house. But I like to move a little more often than that, to the extent that I think people in our company who look after our KYC stuff think that I've got someone on my tail. But I haven't, I'm just indecisive. But as a result of moving a lot, I've picked up some tips about how to do it. And something you'll have been through if you ever moved before is having to box everything up. So before moving day itself, which is stressful enough, you have to spend a couple of weeks going through, trying to pack everything away, go, oh, have I used this for the last time, or am I going to need it again? All that rubbish. And I hated doing that. And I said to my friend Shona one day, I wish you could just get someone to come into your house, box everything up for you, take it to the new house and unpack it all for you. So you could just walk out the door, walk in through the next door a few hours later and it's all done. And she said, oh yeah, there is. I've done that. So I looked into it, and some removals companies do have this option where they will just do it all for you. So we literally did this last time we moved. I think I'd finished recording a podcast. I just left everything like it was, still had my cup on the desk and everything, walked out, went off and did some work, walked into the new house, and everything had just been set up. Like I missed the entire thing happening. So I suppose, Rob, this is kind of two tips in one. The first is, if you're moving, this is so worth it. Yes, it costs more, but not dramatically more, and it is so worth it. And the second is, if there's something that you don't like doing or that you wish existed or you wish there was another way, it's worth questioning. It's worth Googling it or asking a friend or something, because if I just accepted this is what you have to do, I never would have found the solution. So I think it's worth questioning and being curious. Is there a better way? And just doing a little bit of looking into it, because when there is, it's pretty awesome.
That does sound pretty awesome, but I'm desperate to know, Rob, was the cup on the desk when you arrived in your new house, in your new room? Was it there?
Sadly not. But I was hoping that it might even have been like washed up and refilled with fresh coffee. I think you have to pay for the next package up for that one.
Oh, well, you nearly got me to move house then if they'd done that, but I think I'll sit still for now. But that's a great resource. And it'll be a great podcast on Tuesday because it's Ask Rob and Rob, where we'll be answering your questions. So make sure you join us for that. And of course, we'll be back next Thursday for the main event, the Property Podcast. So until then, take care, have fun, bye-bye.
Bye-bye.